We have a couple questions via email. First, Lance on zebra spreads. Comparing zebra spreads to other strategies. Zebra spreads made popular by Tasty Trade. Tasty works at Tasty Trade team, Tom Sosnoff as well. And then a quick question from Jeff. So let's get into this zebra trade idea. One moment, that came in from Lance. And let's just, sorry about that. There we go. All right, so the zebra spread versus a married put position. Or is it really versus just buying a long call in this case? All right, so let's go ahead and take a look. Lance, 2 weeks ago, Lance sent me a question before the webinar on the 23rd. And it was about at 2 p.m. Eastern time, before 4:30 p.m. Eastern time, so about 2 p.m. Eastern time on the 23rd of January. He says, in your next webinar, can you compare zebra spreads? Buy.to 70 delta calls, sell one 50 delta option to married puts. Now, we didn't do a webinar on the 23rd, and I didn't have real good insight heading into the January 30th presentation, and you'll see why in a moment, but let's give it a go. Let's see what we've got here for Lance. All right, what is the zebra spread? The zebra spread is a stock replacement strategy. As I mentioned, it was made popular by Tasty Trade and Tom Sosnoff. Rather than buy a stock which is capital intensive, or use a married put position, buying a stock and buying an out-of-the-money put, for example, which is also capital intensive but has a controlled low risk, or you just buying a call option itself, buying a long call, they're looking at a position to buy two in-the-money calls with a delta of 0.7 or 70, if you want to call it that way. On power options, we use a decimal. And sell one at-the-money call with a delta of 0.5. An at-the-money call, essentially. So buy two lower strike calls, sell a call 0.50. It's a ratio back spread, essentially. Or you could look at it as buying a long call and doing a bull call debit spread at the same time. So I buy a call with a delta of 70, I buy another call with a delta of 70, and sell an at-the-money call with a delta of 50, I've got a long call position with a bull call debit spread. This is the profit and loss of the zebra position. Right now, AMD is at 207.25. You'll see why I use this little example in a moment, but AMD is at 207.25. Looking at the option chain, the 20th of March, about 42 days out. It's a shorter term trade. Now they recommend 2 weeks out, 3 weeks out, 4 weeks out, monthly trade. Shorter term stock replacement strategy for a bullish movement. Instead of buying the stock at 207.25, instead of doing a married put, which might cost me $21,400 for 100 shares in one put, I'm going to buy two March 190 calls at 26.08, and I'm going to sell a March 210 call at 14.78. This is going to put my total debit at 3,730, 740. Let's just call it that. So there we are. Rather than buying 100 shares of stock at 20,000, rather than buying 8 or 9 shares of stock, which would be the same equivalent of about 3,700 or so. Now, more than that, double that, 16 shares of stock, or doing a married put, buying the stock and buying a 190 put for March. Shorter term, but it would have a cost basis of about 21,600. So here, what do I have? I have unlimited upside, just like a stock position, just like buying a call. We have a known risk, a maximum risk of only 3,738, the debit we paid into the position. This is a known risk because it's a debit trade, but it's not a low risk position. In either case, I can sell other income against it. I could sell a 215 call against this, make this a different trade, try to generate shorter term income using February options and so forth, just as I could with a married put or with the stock position as well. Okay, so we've got that. That's the zebra spread. Buying two calls, delta of 0.7, selling one call, the 210 strike, which was a delta of about 0.51 when I looked at the option chain, when the stock today was at 207.25. Lance's question, the comparison versus the married put. Well, I'm not going to compare it against our preferred married put, and we'll explain why in a minute. But in this case, I'd buy 100 shares of stock, as I mentioned, of AMD at 207.83. The March 190 put. Why the 190 put? Because that's the same pivot point. That's the same 0.7 delta call that we would buy. So the comparison would be that same strike as a married put, a short-term, out-of-the-money married put. My cost is $21,565. The put guarantees that I'm going to get 19,000 back, or 190 back. So my maximum risk is 2,565 roughly, or about 12%. That is the absolute worst case scenario if AMD fell to 180, 160, or 150. Upside is still unlimited. Break even is at 215.66. That's important. Is it a higher cost? Absolutely, it's a higher cost. It's 83% higher than doing the zebra trade we just looked at. 3,700 versus 22,000. Absolutely. But it's a lower risk, both monetarily and percentage-wise. Remember, you're risking 100% on the zebra spread of what you invest into the position. Now, I had to compare the zebra this way because of the structure they used. Shorter term in the money calls equates to shorter term out of the money married puts. And as I looked at this discussion from when Lance gave to me, I said, why wouldn't we just do it the other way? More often than not, I have to compare our preferred married put approach to just buying a call option. Isn't it the same? Isn't that married put position you just showed me on AMD of buying stock, buying a 190 put, putting up $22,000? Isn't that the same risk reward profile of buying the 190 call at 26.45? Our argument isn't that the profit and loss chart isn't the same. Our argument is, on most occasions, that this is not a parity trade to the married put position. This long call we're seeing on AMD with today's prices, does it risk about the same? 26.45, the cost of the call, versus about the 25.65 that I had on the married put. Yeah, we'll call that similar. Do both have infinite upside profit? Absolutely. So does the zebra spread. But this is 100% risk. It's not a low risk trade. It is a known risk. You know the risk is 26.45 compared to $22,000 of my investment with 100 shares of the stock and one out of the money put where I can only lose 25.66 or 12%. You're risking 100%. So you say, this is a better trade. If the stock moves up 10%, I'm going to see a 40% gain. If it moves up 30%, I'm going to see close to an 80% gain. And you're not wrong. But if the stock falls 20%, the stock falls 15%, you're risking 100%. And you're going to say, Mike, that's still a better trade. I have $25,000 to invest. I invest in a married put on AMD. Maximum risk of 2,600 or about 10% of my total portfolio. You say, okay, I'm going to do the same thing as Mike. I'm going to buy one call here or one zebra spread. The one call here risks 26.50. Zebra spread risks 37.37. We also have $25,000 left in our, well, we had $25,000. I don't anymore. It's all in my married put on AMD. Are we at parity with this long call against my married put? No, because what are you going to do with the remaining $22,000 that you have in your account? You're going to buy another 5 contracts on stock ABC. You're going to buy another 6 contracts on stocks XYZ. You're going to trade a debit spread here, credit spread here, do this. And now you're risking close to 50 to 60 to 70% of your total portfolio in those 10 positions where I'm risking 10. The long call is not a parity trade to the married put unless I buy this call and I put the other $19,000 or so to $20,000 I would have used to buy the stock aside and don't trade it with anything else. So my risk is now down equal to that 10, 11, 12% we saw on the out of the money married put position. Same with the zebra spread. It has a known risk of the debit that you pay to get into the position. It's leverage because you're using leverage to get more profits. But at the same time, if you overtrade, or if you use the rest of your account to overtrade similar positions, your market exposure is much higher. This is the battle. Why do you keep babbling about this known risk? Both the zebra spread and the long call are clearly low-cost positions compared to the married put, compared to buying the stock. They are stock replacement strategies. You only risk the debit. But it's not a low risk unless you control the risk in your portfolio. Leverage spreads of any kind, buying a call, debit spreads, credit spreads, buying a zebra spread position, you can fall into the trap of gambler's ruin. If I lose 10% of what I invested, do I need a 10% gain to get back to break even? No, I need an 11.1%. If I lose 50% of what I invested in the trade, which by the way is a common stop of investors who buy calls, use the zebra spread, use at the money or just out of the money bull call debit spreads 40, 50, 60 days out in time that have a 1-to-1 risk reward ratio. But when they see a 50% profit, they take it. When they see a 50% loss, they close out. But if I take a 50% loss of what I invest in that trade, whatever I invest back in with the money I have, I need a 100% gain to get back to break even. If I lose 5% on a controlled risk position, I don't need a 10% gain to get back to break even. I only need a 5.6% gain to get back to break even. That's the lie of leverage. The three core principles of any trade, stock, options, futures, in our opinion, what we discuss in the blueprint is, first, force an ideal size trade. Avoid that gambler's ruin. Leverage trades at risk 100% do not follow this unless you do. What do I mean by that? In many presentations, you've heard me talk about how 15%, 12% of my portfolio at any given time is in bull put credit spreads, following my preferred default search and power options that I tested and I've been trading since about 2018, 2017. But it's only 12 to 15% of my portfolio because I'm risking 100% of the margin requirement. There have been times, and it happens about every 18 months, sometimes more frequently, where the sudden black swan event happens. And all 3 or 4 of my bull put credit spreads are down 40 or 50%. I close them instantly at that time. Why? Because now I've only lost 6, 7.5% of my total portfolio value, not allowing it to go to 12 or 15%, which means if I only take a 6% loss, I only need about a 7% gain remaining on that capital I have to get back to break even. It's not 80% of my portfolio, it's not 90%. You see a low risk with a low debit. It's a leverage trade because you're shooting for more profits, absolutely. But it doesn't force an ideal size trade unless you do with proper discipline. The at the money bell curve, when we are looking at options and we want to buy options, we want to buy on these outside wings. I'm going to choose, because it's a darker screen here, I'm going to choose a different color. So just give me a second here. There we go. So when I'm buying, I want to buy here on the outer wings. Look at any option chain, any expiration. What are you going to see? The options that are right at the money. In our case, with that AMD example, when it was at 207, the 210 strike at any expiration has the highest time value. Down here, we're talking about calls. If we're in the money, we're paying a higher price. But most of that is intrinsic. The time value is lower. And if I'm buying out of the money calls above the stock price, I'm paying a lower premium. Yeah, I have a lower probability of success. But we want to be buying on the wings here. And we want to be selling, of course, where? Where the time value is the richest in this range, based also on our expectations of the underlying stock. So really all 3 that we just looked at satisfy this. The zebra position, we've got the long call, we added a little bull call debit spread flare in there. The call we're selling is a 0.5 delta right at the money, maximizing the ATM bell curve. We're buying 2 in the money 0.7 deltas. We're satisfied with the ATM bell curve. The married put, we bought stock. We bought the out of the money put, same strike, satisfied. And the long call, buying just 1 in the money long call, satisfied. All 3 satisfy the ATM bell curve rules. We're not buying at the money 2 calls and then selling out of the money here, which wouldn't satisfy the ATM bell curve. Now, the time decay curve. The time decay of an option, based, of course, on the stock not moving, based on implied volatility staying the same, and so forth. Here we go. Rapid time decay within the last 30 to 60 days. When I'm buying an option, I don't want to be buying 30 to 40 to 50 days out in time. I want to be buying out here, 90 to 60, preferably 120, preferably 150 to 180 days out in time to give the position more time to move in my desired direction. Right? I want to be selling here 1 week out, 2 weeks out to maximize the time decay of that option, that premium that I'm selling and hoping to collect in my favor. Zebra trade is based on a shorter term position. From what I've read, I'm sure we can do it different ways. But the initial structure is based on maybe a 40 to 60 day out in time. We used the May 42 days out, March 42 days out an example. So we're in this range. So it's not terrible. But at the same time, we're selling here and buying here. We want to be selling in this range and buying in this range. Why do I say none solve this? Well, because we had to compare that zebra trade that we looked at for March and just buying the long call or the married put, which is exactly the same risk reward profile in this time frame. In my opinion, all 3 of these want to be out of here. So none of them solve, none of the examples we just looked at that are fair comparisons. The zebra trade shorter term using the in the money 0.7 delta with a 0.5 call correctly matched the ATM bell curve. The in the money long call 190 strike 1 only, lower risk than the zebra trade. Great. There we are. Satisfies the ATM bell curve and the out of the money married put. But none solve the time decay curve factor. And only 1 kind of solves forcing an ideal size trade, and that's the out of the money married put, but that's not the way to go. What does satisfy the 3 core principles? The radioactive trading approach. Okay. We buy stock. I buy an in the money put satisfying the ATM bell curve, and I go at least 150 days out in time or more. Satisfies the time decay curve, forces a nice deal size trade to single digits, risk of only 5 to 9%, satisfies the ATM bell curve. I'm buying on the in the money wing of the ATM bell curve, and of course satisfies the time decay curve as well. I have less time decay against me in the first 30 to 60 to 90 days. Now, why not compare what I'm talking about or what Lance has using a radioactive zebra? This is not our trade. Okay, we don't do this. Zebra spread is from another highly reputable and very well-known options education platform, and their discussions are to be using it as a leveraged stock replacement in shorter time frames. Their approach, 45 or even 60 days out in time, or even 30 days out in time, is not wrong for what you want to do. And buying the 2.7 in the money delta calls and selling 1 at the money delta call is not a comparison to our married put approach. It's a comparison to an out of the money married put, which we do not advocate at all, shorter term, or a 1 month out long call, which we don't advocate as well. You want to put that time decay on your side. Okay. So I could compare it against doing 180 day out zebra trade, but their specific qualifications are this. Our married put approach is different. Now, what is the one advantage, main advantage I've kind of glossed over here in this discussion of this comparison is what is the advantage of the zebra spread? It has a higher cost than the long call. Remember, our long call was only risking, about 2,500 or 2,600, where the zebra is risking 3,737. The married put was only risking about 25, but we were putting 83% more money into it at $20,000, $22,000 for that married put position. Just 1 month out of the money, which we don't advocate. The advantage here is the break even, okay? If things go your way, the profits are enhanced. You have a break even on this trade of around 208.68, where the break even on that 190 long call that we saw was around 215, 216. That's just a break even. Now, if it goes up to 215 tomorrow, the married put's going to be profitable. The long call is going to be profitable. The zebra spread is going to be extremely profitable. But you get this lower break even and a higher probability of profit due to accelerated gains, because you do have just a 190 call, similar to buying calls, similar risk reward profile to the married put. Remember, I'm still risking 100% of that 3,700. But as the stock moves up, I'm gaining on the long call and the bull call debit spread that we entered as well. So we're getting accelerated profits, gives us that much lower break even. If the stock was trading at 215, 220, or 230, we'd see higher monetary profit and leverage profit on the zebra spread than we would on the long call, or we would on the out of the money married put position, which we don't advocate. So that is the advantage of the zebra spread. Stock replacement, lower cost position, higher cost than just buying the initial call because you're adding the cost of the bull call debit spread into it, but you get a lower break even and you get accelerated profits because you're gaining on both the long call and, in this case, our extra 20 points on the bull call debit spread, especially if it goes above 210. That gives you that lower break even there on the positions. That's a great advantage. It's just like why we use income method number 5. The different ratio call spread, not a ratio back spread, but the ratio call spread in the married put, because it gives you potential higher accelerated profits over just selling a call income method number 1 if the stock moves in your direction. Now we're going to hop over to power options real quick. When Lance asked this question on the 23rd, we weren't doing a webinar, but on the 30th, I did enter 3 positions. The zebra spread as would have been done at the time, the out of the money short-term married put, and the long call. And I used AMD at the time. And that was a bad example to use. You just saw the comparisons of what current positions would look like with AMD. But I used that on the 30th, and we've seen whipsaw markets all over the place. We'll probably talk about that a little bit as well. But yeah, so this didn't work out, but you can see the examples on the down one. I'm probably going to have to do an example for Lance on an up one, so you can see the break even and benefits of the zebra trade in an up position as well. All right, so let's go over to power options here. And what I want to do is navigate to the portfolio. So I'm going to click on my portfolio where I can access the portfolios, all of my history, transactions, allocation, and more. Let's just go to portfolios here. And here's the zebra trade. On January 30th, before the webinar, I was trying to put this together, AMD was trading at 236.73. As you can see, it's now at 208.44. It's down 12% from the initial entry price. At the time, with the stock at 236.73, our zebra trade. It's called a bull call debit, but you can enter and track zebra trades in the portfolio. We would have bought 2 March 220 AMD calls at $30.40 and sold the 240 call, had a delta of 0.51 at $19.35. Let's take a look at the profit and loss chart. That would have been the zebra trade on January 30th had I presented this for Lance. What do we have here? We have a known risk to the downside. It's not low risk if you control it. A risk, total cost, debit, $4,145. We have a break even of 241. Now remember, that was when the stock was trading at 236.75. So it's really close to a break even, because we're accelerating this profit range due to the bull call debit spread linked with the long call in this structure. But now the stock is down, and as you can see, we're losing $2,488, or roughly 60% of our investment into this position. We likely would have used a stop of 50%, and exited this position already due to the movement in AMD. The long call, well, we bought this 220 call, bought two of them, and sold one against it to get that better break even. The 220 call here, cost of 30.40, which means risk of 30.40, but liquidation value is 1100. We're down a little bit more. We're down 63%, and again, likely would have closed, rolled, or adjusted this long call position when when the long call hit a 50% loss. Now, $3,040 into here, $4,145 into the Zebra trade, not where we want to be. And the Married Put itself, cost basis of $24,893, would have used the March 20th 220 put. Why? Because that's the pivot point. That's the fair comparison against the 220 call. This isn't the Married Put I would have done on AMD if I opened it on the 30th. This is the put that's the comparison to the standard Zebra trade as outlined by Tasty Trade, Tastyworks, and the 220 call parity trade. Not a parity trade, as you can see. Down $1,800 or 7.6%. So if I liquidate this Zebra spread now, take a 60% loss or took a 50%, what do I need left of the $4,145 I invested to get back to break even? Well, at a 60% loss, I'm going to need about 132.1% gain, I think. Have a 63.7% loss. I'm getting close to 140% gain on the 1,100 I have left to get back to break even. I take a 7.6% loss, $1,889 against a $24,000 investment. What do we need to get back to break even? I think it comes out to 9.1%, if I'm not mistaken. 9.2, I think. 9.2, 9.3%. The lie of leverage. Yes, I'm losing about the same on one contract of the long call as I'm losing on 100 shares and one put of the Married Put position, not even the Married Put we would advocate. But again, the lie of leverage. 63% loss of one invested. This had to only be one or two contracts. It had to only represent 1, 2, maybe 3% of my total portfolio, because I'm losing more on the long call, but it's equivalent to what I'm losing on the Married Put. But the lie of leverage, if I put 20% into this one position, this long call position, 10%, I need a much bigger gain to get back to break even. And on the Zebra spread, the same thing. It's at a higher risk because it dropped down. If the stock had moved up, I apologize, 12%, we'd see different values on these positions. And we'll talk about that later when we expand. I'm sure there's going to be questions on the YouTube post on this, and maybe we'll even get some Tasty Trade comments. I'm not denouncing the spread trade. All right, I am not denouncing the Zebra spread. What I'm saying is it's a stock replacement strategy, gives you a better break even and higher profits than just buying the call, probably even higher profits than doing an in the money, at the money, bull call debit spread short term. Percentage and monetary profits are going to be higher than the out of the money Married Put position. What I'm saying is it's not a low risk strategy, and yes, you make it a low risk strategy. Allocation is principle. Allocation is key. And Lance, that's what I have for you. That's the comparison in my mind right now, the three positions. And when I was doing this for Lance, I kept going back to this idea that I'm not really comparing the Zebra spread. Oh, sorry, folks. I'm not comparing the Zebra spread in reality to a Married Put. I'm more comparing it to the long call position, aren't I? That seems more of an equivalent leverage. What is the profit and loss of the long call versus the Zebra spread? Is it a stock replacement of the Zebra spread? Absolutely. Is it a comparison to the Married Put? Absolutely. But a 1 month out of the money Married Put, not at all what we advocate going forward with the blueprint positions for longer term growth using the 13 different income methods to lower that initial risk and get back to break even. You can see more about the blueprint here on Power Options, and of course, just at radioactivetrading.com, you can go ahead and get the sketch. That's a free white paper. Just put in your name and email address. 9-page white paper introducing the preferred Married Put structure the benefits of the married put structure over other popular option strategies. But the zebra trade has its place, but you've got to control it to satisfy the three core principles related to forcing an ideal size trade. It satisfies the ATM bell curve, as we saw, but you've got to control the allocation in your portfolio to satisfy the three core principles.